So today is Saturday, March 23rd, 2024. So 2 more days until the market opens on the 25th. So that'll be a Monday. And I'm going to be doing the stock of the week. And so this is the stock of the week for this week, the 25th of March. And we're coming up at the end of the January, February, March, the end of the quarter. And I want to point out this stock called Samsara. Samsara. It's a end-to-end solution that allows businesses that depend on physical operations to harness Internet of Things data. Well, Internet of Things is all the rage, or at least it was. Now it's AI. But Internet of Things is basically everything's got a sensor in it, and everything feeds to some central unit, like your air conditioner or your heaters or your lights outside, your cameras, things like that. And there's zillions of Internets of Things now, right? There's cameras on highways, and there's anything that's connected to the Internet is the Internet of Things, and it's not always just the Internet anymore. So that's what Samsara does. Now, this is a relatively new company. They IPO. They came public at the end of 2021. And they did what's called an IPO drop, right? So they go public, and everybody that got rich overnight has to wait to sell their shares, and they just start selling their shares, and then the company has to go all the way around that big drop before it comes back and starts going up. And so that's where we are right now. We're in basically an elongated first stage base from that internet recovery, right? Sorry, that IPO recovery. So let's start over here on the left, and we'll look at the earnings per share, and you can see earnings per share up 7, up 45%, up 43%, up 3 digits, 154%, up 67%, up 79. This is typical of a new company that IPOs, but it's also typical of one of those super stocks, because they usually start out like this. Like they wait, they do all kinds of really good stuff in their company, and their management is executing. And then when they go public, they've already got a track record of increasing shareholder equity. And that's what this company's doing. Look at there's no negative earnings there. They're all just growing. Well, there's negative earnings, but there's positive growth, I should say. So you're seeing there were some negative numbers while they were getting started, which is typical, and now the earnings are going up. So we're positive coming up in 2024, and then next year, 2025, we're positive and almost a double, and then almost another double from there. So that's really good earnings growth, and stocks that are breakout stocks really move on earnings growth. So that's number one. We have, according to investors, we have investors.com. We have a group relative strength rating of 76. So it's not that great, but it's not horrible. It's 76. And we have an earnings per share growth rate that, according to their formula, is NA. So to me, it looks like it's a positive. It's because it was negative numbers, but it looks like some positive earnings growth in here. So I have to kind of look beyond that. We'd like to obviously have that to be a 3-year average of some good number, but it's not. So, we're painting the picture with these little dots. All right, let me whip through this. Up-down volume ratio is 1.2. 1 is neutral. 2 means there's 20% more than neutral are buyers. So there's an accumulation going on, and you can see that in the chart. And then let's go down to the bottom. So we've got our earnings per share. Look at our quarter-over-quarter growth, just recently, our most recent quarters. Triple digits, all of them. Wow, good stuff. Sales gone from 63% to 52% quarter-over-quarter, 49, 48. We like to have 20 to 25% growth. So this is certainly nailing all that. So that's really good on the fundamental side. Return on equity is a little bit low. It's 4%. And that's probably because the company's just kind of plowing stuff back into their company, and it's not all going to shareholder value. But I think it will. Look at the R&D of this company. 28.7% of their capital is going back into making better products. You want a company that's doing that. That's what Apple did. That's what Microsoft did. That's what NVIDIA did. They all plowed money back into R&D. And then these are the results. So now we're going to look at the right side. Now, I want to just say, we can find value stocks, this would have been a value stock back in here when it's dropping. The problem with a value stock is it might be a good value. You just don't know when the drop is going to stop, right? So this went from 30 to 10. That's a big drop, and you would have had to sit through all that if you had picked it halfway through. It's called catching the falling knife. I'd rather catch things on the way up. And that's really hard for people to get their brains around, because when you catch things going up, it means that you have to buy things at their high, right? Or close to their highs. And people are like, oh, it's already at a high, it's going to sell off. Well, stocks that have momentum continue to push momentum, right? It's like we flipped the chart over, and it was a mountain, and we were rolling a mountain off the top of the boulder. We were rolling a boulder off the top of the mountain. The boulder would accelerate. If you flip that back over, you want stocks that have momentum. And you want stocks that have a volume profile like this. So look at the low-ish kind of volume. It's all below that 50-day moving average back then. And all of a sudden, as the stock starts to go up with about 8 weeks in a row of up in here, you see all these blue candles are starting to go higher. And now I call them skyscrapers. They're above this 50-day moving average line. And now the whole personality of the stock has changed. Look, it went from this level of volume to now it's up here at this level of volume. So there's obviously some institutional players coming into play in this game, right? And that's what we want. We want the institutions to be pushing our stock up with them. We want to do what the institutions are doing, not what the institutions are not doing, because we're not going to be able to fight against the institutions. It's just you and me, man. We don't have the ability to fight against these big institutions. So we want to go along with them. If they're buying, we want to buy. If they're selling, we want to be out. So this is what's going on. So I look at this and I see this chart. We have a cup, we have a consolidation, and then we have a pivot. It is right at that buying level of the pivot, which is, in this case, it's $37 and a penny. So 37 bucks is our breakout spot. And now our goal is to, set our stop loss, right? 7% from that $37. And then we also want to set a target. Now we're going to target 20 to 25% most of the time. There's some other rules that we follow, but most of the time we want to make 20 to 25% on that. And then if we're happy to stay in the stock, we can reevaluate at that time. But that should be the time we pull our money off the table, or at least think about it. Or, during this time, you want to think about adding some shares as the stock is going a little bit higher. So I'm going to stop it there. I'm just going to put it out there. You want to make sure you have a stop loss in. The market is green right now. And Samsara is at a perfect spot right now. So this should be on your watch list, and certainly something that if it meets your criteria, you can get involved with.